Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. National Financial Literacy Month is celebrated in April, which is a great opportunity for us to check and promote our financial situation and skills. Joining me for this segment, we have Laurent Laskowski, derivative strategist at Mizuho Americas. He's here to discuss the basics of derivatives and how investors can use them in their portfolio. Laurent, it's great to see you again. Welcome back to Trade Talks.
Thanks for having me, Jill.
All right, let's start with the basics. What are derivatives?
Yeah, of course. So derivatives are contracts whose price depend on the price of one or several underlyings. So several underlyings, we can think of equities, bonds, rates, fixed income, commodities, credit. The list really goes on. And in terms of derivatives, the type of derivatives, we can think of forward, futures, options, CDOs, CLOs, CDSs. Now, a fair amount of these derivatives are traded OTC, and I think today, maybe for the interest of time, we will probably focus on exchange-traded derivatives, so we will probably focus on futures and options.
And how are they priced?
Sure. So, look, futures, for instance, are linear contracts. So when people get in futures contract, they're obligated to buy or sell an asset at a certain time. So these futures are priced depending on interest rates, dividends, and most importantly, the expectation of the price of this asset sometime in the future. For instance, right now, if we take a look at crude oil, the front month future, the futures expiring in 1 month, are trading in WTI at around $100 per barrel. If we take a look at 2 years out, they're trading at about $80 per barrel. So this is a big discrepancy. In fact, just tells us a little bit more about what market participants expect the supply-demand dynamics for crude oil to be going forward, going into the future. So probably the tightness that we have right now to abate a little bit. Now, when it comes to options, options are asymmetric contracts. They allow participants options buyers to buy an underlying at a certain price by a certain time, but they have no obligation to do so. So therefore, there is some asymmetry there. They will participate to the upside and not as much to the downside. So the price for these options that have asymmetries to them depend on top of things a lot on the volatility of the underlying asset that make the likelihood of these options being in the money or profitable a lot higher if volatility is higher. So the higher the volatility, the more pricey the option.
So Laurent, how can
just one last thing that I just forgot about options is that options have a strike price, which is the price at which people get to buy or sell an asset. So of course the difference between the strike price and the current price of the underlying is of course a major determinant of the price of options as well.
And got it. So how can derivatives fit into one's portfolio?
Sure, of course. So when it comes to futures, they're really, really leveraged instruments. So they're mostly used by institutional investors. But when it comes to, I guess, maybe more retail investors, they will probably be more interested by options and the asymmetries that they offer. So particularly right now in this uncertain environment, an investor in equities may be interested in buying puts to have this downside protection and just benefit from the upside should their equities continue to rise, but definitely define their losses to the downside with the strike of this put at which they can sell their underlyings. So that's one example. Another example in this market with volatilities being pretty high would be to sell a call provided that the investor owns the underlying. So they will just benefit from this call premium and just be willing to sell their underlying at the strike price of this call. Now, what is extremely important for investors is to understand that it is crucial that they own the underlying, because otherwise they would sell a naked call, what is called a naked call, and just be exposed to potentially unlimited losses to the upside.
Are they appropriate for all investors?
So again, right, derivatives are leveraged instruments, asymmetric instruments, and they're not appropriate for all investors, but provided that investors really take the time to understand derivatives and use them reasonably, they can offer ways to benefit asymmetrically, benefit from the asymmetries of derivatives, hedge to the downside, and make some income potentially with some of these covered calls.
All right, and Laurent, to wrap up here, when we think about the bottom line for derivatives, what do you want investors to walk away from?
Yeah, so I think that really the bottom line specifically for options is this asymmetry that they offer and allowing really investors to tailor their portfolios to their expectations. So for instance, if they're afraid of the markets going down, they can just curtail the downside by buying puts. If they think that the market is not going to go up as much, they can potentially sell calls on their underlyings to just harvest some premium there. So again, asymmetries in options.
All right, Laurent, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.